You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Options Bootcamp is brought to you by NASDAQ. From its inception, NASDAQ has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. NASDAQ, tech forward, leading the U.S. options market and continually rewriting tomorrow. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and Jill Malandrino.
All right, everybody. That music means it is time once again for Options Bootcamp, the program here on the old Options Insider Radio Network, where we take the sometimes scary, sometimes impenetrable, sometimes highly volatile world of options, and we break it down for you. Maybe you're a stock guy, you're looking to dip your toes in the options waters. Maybe you've been doing so for a little bit, and you think maybe it's time to graduate to the next level, get a little bit more familiar with these options concepts. Either way, we got you covered. My name is Mark Longo from the aforementioned network, as well as, of course, from the old optionsinsider.com. Make sure if you just listen to this show, now a lot of you like this show. I know. Make sure if you haven't done so already, make sure. A lot of new listeners discovering this program all the time. Make sure you get on over and subscribe to the full network out there as well. We love boot camp, but there's a whole array of other content out there waiting for you. Pretty much a dozen shows, so no matter where you find yourself on the option spectrum, we have something out there for you. And, of course, you can get it on all the major platforms, including your iTunes, your Stitchers, your Google Podcast, all that good stuff, or available. A lot of you like it on YouTube these days. We don't judge. However you like it, of course, you can always join us live when we hold the recording sessions like some of you are doing right now. And, of course, however you listen, make sure you keep those questions, those comments coming. We'll see if we can answer a whole bunch of them on this episode and, indeed, on the next episode as well. And joining me, I am pleased to say, once again, returning, making his triumphant return to the Options Bootcamp program. He is the black-hatted one himself, my co-drill instructor on the old program, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the program. We missed you last month on the show, sir.
Oh, yeah, it is great to be back, Mark. Love it.
And how are things going in the world of Market Taker since we last chatted? Are you guys crazy busy over there in these mad markets, sir?
Yeah, been doing a lot of earnings trading, which is kind of fun. So that's what I got cooking.
Oh, are there earnings going off right now? I had no idea. I've been ensconced in other things.
Maybe a little.
Just a little bit of earnings popping off right now. And you heard the man at the top of the show, Jill, not joining us today, but we got an able replacement filling in on the old NASDAQ hot seat. He's a newcomer to the program and indeed to the network. He is Luke RAHBARI, the CEO at Equity Armor Investments. Luke, welcome to the Options Bootcamp program.
Mark, thanks so much for having me.
And Luke, as we are wont to do with all of our first-timers here on the network, why don't you go ahead and give our audience a little bit of an overview of your background in the options and derivative space, as well as what the heck it is you guys do at Equity Armor Investments.
Yeah, sure. So I've been into options for a while. I started working for my dad's broker in 1986. I'm not sure if either one of you guys were alive back then, but way back when.
I'm only 22, so I have no idea. I have no idea what that year 1986 even means, sir. It's way before my time.
Right. Dan's still in high school, from what I hear. So
I act like it.
Yeah. So, it's interesting. I've been around since that time. I started on the floor of the CBOE at around 92. I worked for a biggest market-making firm at that time, Letco Trading, and was an independent. And then I ran their largest specialist firm back in the .com days. We had Oracle, Cisco, SAP in there. After that, our company was bought by Toronto Dominion Bank that owns TD Ameritrade, and I ran their U.S. equity derivatives desk, and then went to London in 2006 and did some global flow over there. Came back to Chicago 2011, got with my partner Brian Stutland, who is a regular contributor on CNBC. They call him the fearmonger because he's the VIX expert, and had a floor trading operation. And then we switched up gears and started to create products. We have our own proprietary vol index at the CBOE, and we currently trade that in a mutual fund right now, where it's long equities and long our vol index. We also do consulting. We create products for third parties. We run some money in a CTA, trading our vol strategy and S&P futures and options. So still pretty much stuck in that world of options, different products, but doing different things with it.
So you're not busy at all. And meanwhile, we're pretty busy, so let's get to it with a little bit of the old basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Pull in, prepare to learn.
I love it. Wish we can do this show every day just because it's so festive, the music. It puts a smile on my face, makes me feel like 4th of July out here waving some sparklers. Of course, welcome to the basic training portion of the show. We break down some basic options concept that you can utilize in your own portfolio. Before we do that really quickly, because we are in such rarefied environments, pretty much every time we all gather here together on the network, something crazy is popping off in the marketplace. As we're gathering here together right now to record the show in early May here, we're seeing green on the screen yet again. Most of the major indices feeling their oats, feeling the love, up over 1. Some of them close. NASDAQ over 2, about 2.25% to the upside. Even oil, which can't catch a bid, catching a bit of a bid out there today. So a lot of love out there in the markets. I guess we're in a little bit of a bloom is back on the rose after a lot of dire news. So a lot of crazy stuff has been happening, of course, even since our last episode. Sell-offs, news about the pandemic, corporate earnings, this new, once again renewed, will they, won't they dance with us in China, all these other things going on that have sent us into the stratosphere and then back down again, and vol up and coming off, and a lot of madness. So maybe let's start there really quickly before we get into our basic training for today. Luke, we'll start with you as our guest. What are you guys hearing just broadly from the Equity Armor clients and users right now about this marketplace, about these volatility levels? Are they starting to feel a little more comfortable with vol having spiked and then now coming back in, a little bit more comfortable with VIX hovering in the mid-30s to 40? Or are they maybe starting to fade these levels? Are they looking to load up on vol? Are they fading these overall market valuation levels? What are you hearing anecdotally out there, Luke?
Well, Mark, it's interesting because it's all of the above, actually. A lot of people, if you look at the levels of the indices, of where the low was, how low we got, and how high it was before everything started with the virus, we're getting close to those levels, but a lot of the companies have not only suspended dividends, but they've suspended guidance, right? So it's hard to say that a lot of people are enthusiastic, but then the Fed came in, did everything they did, and it's pushing people back into risk, which is what they wanted to do. So I think a lot of our clients, or what we hear, they want to be in higher beta stocks. but they want to own it with a hedge or a vol, which is obviously very good for us because they have a little bit of fear of missing out. And I think there's stock picking is definitely back, and there's going to be some winners and losers, but there's going to be a lot of volatility. I mean, let's remember, this is an election year. We still have that to look forward to at the end of the year if everything else goes smoothly, and I'm sure there's going to be some bumps along the way. So people want to get back in the market. They have to be invested because you're not getting anything in the fixed income markets, but they want to own it with a hedge or with some vol.
Dan, same question for you. What are you hearing from your mentees, the new and existing clients over there at Market Taker? Are they looking to get back in at these levels? Are they getting a little bit spooked that the rally perhaps has been a little bit too aggressive and perhaps they want to hedge again? What are you hearing out there, Dan?
I think a lot of people are sort of cautiously optimistic. I love throwing that one out there. I think people who have dry powder are kind of holding on to it a little bit, but still doing a lot of like active trading. I feel like a lot of the people who try to scale back into their investments probably already did, and if they have some cash, they're waiting for the other shoe to drop if it drops. But as far as the active traders go, I mean, they're just they're loving this volatility.
Well, let's see if the traders love what we got going on here today. It's interesting, though. Today's topic is not one that I traditionally associate, particularly with the audience of this program, which is, of course, that basic retail trader, because it's much more of an institutional, effectively interest rate or carry play, and usually not the sexiest of ones. I thought this was pretty much a very boring institutional type carry play. You see go up in big indexes like the S or the NASDAQ or things like that. People want to usually carry a little bit of capital, take advantage of some rate environments out there. They use trades like this. And a number of months back on one of our other programs, we had a broker bring up that people were asking them about box spreads. And I said, that's strange. Why would a retail even want to know about box spreads? And that kind of brought me down. I started looking it up, what people are thinking and asking and seeing about box spreads. And it kind of brought me down a surprisingly active and aggressive rabbit hole out there. Apparently, this is a much more contentious issue these days than I ever thought. Huge, deep forum threads and debates about these spreads and what the use case is, what the utility is. Brokers encountering a lot of problems. And so it's been on the back of my mind that maybe we should probably discuss it on this program. Then we got a listener question about this topic, which provided the perfect fodder for it. This came from Alan Trohe. He's saying, hey, guys, love that boot camp is back. Well, we're glad to be bringing it back to you. Hope you guys are liking your weekly doses here of the old OBC back on the network. We're happy to have it back as well. He goes on to write, I'm binging on all the latest episodes. I missed Dan last time. Well, look at you, Dan, getting a little bit of love. You missed Dan last time. Hope things are okay, and he'll be back soon. Well, he's back right now, so you don't have to worry anymore. His question is, my question has to do with box spreads. What the heck are they? And why is everyone talking about them? And you just do a quick search for box spreads, listeners, in Google. You could see pretty much what he's talking about. These are surprisingly contentious these days. In fact, we've seen a lot of issues. Big brokers, I think Robinhood recently, probably most infamously, had a big loss. They effectively marked it incorrectly. Traders putting on positions they think are minimal to no risk. And then all of a sudden, and there's one article here, this trader lost 2,000% on a position he thought had no risk. So there's a lot more lurking under the surface with these spreads than I think any of us certainly assumed. And certainly for this audience, again, just because we're talking about them here doesn't mean we're advocating that you do these. In fact, I'm hard-pressed to think of a scenario where I would recommend these for a retail client. But that said, you should be aware and should be cognizant of what these things are. Let's just run through a basic example. Luke, you're our guest. I'll allow you pride of place if you want to go first. Just give us a basic overview, your thoughts on a box spread, what it is, what the use cases are. If you want to throw out an example using everyone's favorite XYZ, you can. If you want to, you're in the NASDAQ hot seat. If you want to throw out an example using NDX, whatever you feel like using out there, sir, have at it. But in general, what is a box spread to you? What is the use case for it? And also more applicably, maybe for our audience, what do you think is its use case for a retail customer out there?
Yeah, well, I don't think there is a use case for the retail customer. And I know I'm going to get a lot of hate mail on that one, but The box spread used to be, in the old days when we were on the floor, and then when we're upstairs, it's for big institutional players, as you said, to try to take either advantage of price inefficiencies, which got harder and harder to do, or try to take advantage of an interest rate differential, sometimes having to do with the margin they have to pay at their brokerage versus what the margin is on getting this box spread done. And I'll kind of get into that real quick. But basically, it's when you buy a call spread, let's say you buy a $5 NDX call spread, and then you buy a $5 NDX put spread, the most that spread could be worth is $10, right? So what you try to do is you try to look for price inefficiencies and try to buy that for $9.90 or $9.80, or try to get as close as you can from under $10 as you can. What happens is people try to leg into it. They do one part, they do another part. Sometimes it works, sometimes it doesn't. But it's really, they tout it as a risk-free trade, but as a lot of people in the last few weeks, the last month have found out, it is not risk-free. You've got to be careful with a lot of things on the spread. First of all, are you going to be exercise cash exercise? Are you going to get the stock? Is it an index? Are you sure you're trading European or American options? There's a lot that goes with it. And I think the way some of these people got caught is they thought it was a riskless trade. Hey, I think this thing is worth 10. I bought it for $9.95. I'm going to make that. I did it 1,000 times. I'm going to try to make that money on it. And then they were exercised early on a part of the spread. Now they've got delta risk. They weren't delivered stock. They were delivered cash. So now they're short deltas. Frankly, I just think it's been pushed a lot because for retail brokers, it's great. They tout a risk-free trade and they get commission on 4 sides of the trade. By the way, you also got accounting commissions when you do this stuff. And I think that's why a lot of people in Robinhood did it, because they think they pay no commissions, but their order flow is being sold, so they're not. Anyway, that's another story. But I don't think there's any place for it for the retail investor. I think you're better off trying to look for other trades than trying to put something like this on and making the money off an interest rate spread.
Yeah, I first encountered these back in my early days out in the SPX pit, and the reason they're called box spreads, quite effectively, listeners, is because when you look at them on an option chain, they look like effectively a box, the 4 corners of a box. Usually, we used to see them out in the S, but you could see these in any product effectively. Usually, it's in large indices, but they can go anywhere. There's a carry play to be had out there, and effectively, what it used to be would be probably a deep in the money call, and then buy one strike and then sell another strike. A little less in the money, so a little bit, maybe like 100 handles away, something along those lines in the S, and then you turn around, do the same strikes on the put spread side as well. Those are effectively worthless options, of course. So then you look at it on the 4 corners, it looks like it's shaped, if you drew lines connecting each of those contracts you just traded, it looks like a box, hence the name. And effectively you have and as Luke said, you have really no net residual positions on the strikes, and it's effectively just a little bit of interest rate play, which is why people look at it and think of it as this risk-free trade. But there are inherent risks to doing it. Dan, I'm curious, A, what are your thoughts on this whole box spread? B, are you surprised they're as contentious as they are these days? C, have you had any clients or mentees come to you and saying, hey, I read about this, I want to do this, and if so, what did you counsel them, sir? A lot to unpack there.
Yeah, I mean, it's just like Luke said. I mean, it's basically like a way to either to leg in and out of stuff if you're an active trader, like a market maker or something, or a way to borrow money. If you can borrow or lend money for that matter. If you can buy a box for, because if it's a box that can be worth $10, like Luke's example, if this is a year out in time, then there's an interest rate component. So you would buy that for somewhat less than $10, basically, specifically the interest rate amount less than that. But the problem comes, and so there's really no reason for a retail person to do it. Anytime anybody comes to me, I think it's more curiosity, like, hey, is there anything to this? And my answer is always no. But the problem comes where stocks are American exercise, and if options get exercised early, you can end up in a whole bunch of trouble, So, yeah, I mean, there's nothing to gain and way too much risk if something weird happens.
Yeah, I mean, you're putting these spreads on for pennies, if that. And one of the reasons they're popular in the SPX, that's a European contract. So you don't have that early exercise issue where if you're doing it in a stock, you're right, you do have that early exercise. So all of a sudden, one of these legs could disappear, and you're left holding the bag on a very meaty contract. And all of a sudden, maybe you have delta risk, something that you didn't intend. And all of a sudden, it's a completely different beast than it was. Yeah, these were done by professionals, mostly in European-style indices, usually because to take advantage of some sort of favorable interest rate that they had versus what was being priced into the market, so they can make a few cents on this, park some capital, and take advantage of it that way. The retail doesn't have the same margin capacity as the professional traders do, so they can't take advantage of that. They don't have the same access to lending and to rates, really, that a lot of the professionals do. They usually have a hard time doing size. You need to do a lot of size to make these types of trades pay off. So there's so many reasons why they are not favorable to retail, yet you still see them. Again, if you just do a quick Google search, you'll find that people discover these on their own. They say, oh, look, I can do a $10 box in XYZ stock, and I can do it for $9.90 or whatever, and now I'm making it's a dime of risk-free profit, and I can do this over and over again. But remember, you got four legs. Even though commissions have gone down in the options world, they are still there, so 4x your normal commission rate. There's no ticket charge anymore, but you're still paying roughly 65 cents a contract at most brokers. So remember, factor that in now. It's going to eat away at your profits. And also, like you mentioned, there's inherent risk. Particularly, a lot of people are doing these in American exercise equity options, which is not the desirable place to do them. So again, we're not going to spend too much time on box spreads, give you a little cursory overview of what these are, effectively what people perceive to be a risk-free spread that, unfortunately, for a variety of reasons out there, is not exactly risk-free. So if you're out there surfing the web and you see someone hawking a course on box spreads or how to trade these risk-free trades with no skill and not much capital and things, just run the other way. This is an institutional carry play. It really has no suitability or use case for retail. At the end of the day, for very little to nominal profit, you are putting on more risk than perhaps you understand or are willing to deal with. And often the brokers don't really understand it as well, hence all the issues you find when you search for this and brokers having huge out trades as a result. You don't want to be in that scenario either. So, moral of the story for a lot of the audience of this show, and pretty much everyone out there listening, box spreads, not the place to tie up your capital for a significant amount of time. But we are going to tie up a little bit of time we have left with some of your questions. Let's get to it, a little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call portion of the show where you guys take the reins. A lot of people were asking Mr. Dan about your recent comments on the show about how you were liking yourself some USO puts down there. Of course, USO quite infamously has undergone some issues of late. Looking pretty good today, rallying a bit again today. Of course, it has reverse split and a bunch of other things have happened out there as well. Let's just get to a couple of these, Dan, and you could give us your thoughts. These are related questions. First one comes from Cruz. And maybe it's Tom. Maybe Tom's writing in, Dan. He wants to know, is Dan still a USO bull now that it's all negative? I don't know if it's all negative. I think maybe this came in last week or so when WTI was going negative. But still, USO itself is not negative. And then we have a similar question from Sweetlight. Sweetlight wants to know, does the host selling USO puts still believe the product will survive? And is he selling more puts after the split? So, Mr. Dan, you have been invoked. What do you have to say here for Cruz and Sweetlight?
Well, this is the nature of being a trader, is that when things change, you've got to change with them. And I am not in USO at all anymore. There's just too much risk. Specifically, I mean, hey, this is a great segue from the box conversation where it has this sort of not really hidden risk, but very unlikely risk that people don't think about. I mean, it's the same with a lot of different types of ETFs, particularly ones that invest in futures. Default risk. Like there is a possibility. I mean, it looks like things might have stabilized, but there did exist for a while and still exists to some degree the possibility that USO could go to zero or theoretically below. And I'm not saying I believe that's going to happen, but that's a game I don't want to play anymore.
We asked our audience specifically about that game last week. We asked you guys, this is more like a week and a half ago now, when all the madness was unfolding in the crude oil market. We asked you guys, a lot of people were asking if USO is going to be the next XIV. Is it going to go away? And so we asked you guys, is USO going to join XIV in that infamous Franken product dustbin of history? So quite simply, is it going to be trading at the end of the year? This is when crude was spiraling towards negative and all sorts of madness was unfolding. And you guys said yes, but by the slightest of margins, only about 55% saying yes, 45% saying no. Mr. Luke, I'm curious for you, have you guys over there, it seems like no one is immune to this conversation. Even folks who are hedging in equity volatility land have to be dragged into the USO conversation. Everyone wants to have it. So I'm curious, have your clients been asking you about this, maybe looking for hedging out in the USO space, and what are your thoughts on everything that's been unfolding out there of late, sir?
Yeah, we've gotten a lot of calls. I'm a weekly guest on a couple of times a week on another national show, and I usually talk about crude. And for 2 years, I've been saying there's too much crude in the world. What I didn't know was that the storage had gotten so tight in crude. And I think what Dan was saying previously is we can get into how ETFs are constructed or what they're about, but you've got to be really careful about ETFs that trade futures, and you got to be really careful about ETFs that trade commodity futures, because that's a whole different game. You have to read the prospectus. And what happened with USO is some very smart players that are in the oil market read the prospectus, and they knew what the product, what the limits were, what the product was about, and they started to lean on it pretty hard. And it kind of separated people that kind of know about oil, this is afterwards, and didn't know about oil, and they're like, oh, USO, I'm going to, I saw one guy who's on TV a lot, I'm going to buy some oil, it's going to be a great investment for my kids, but obviously he's never traded oil because the delivery, right, and the storage. So quick example, if oil costs $10 a barrel, you got to put it somewhere. And by the way, oil isn't stored in barrels. It's a measurement. But you've got to put that somewhere. And if it costs $12 to store it, right, -2 is the price. And since there was no storage anywhere and it was all full and people had to take delivery of this stuff, it kept going lower and lower and lower. And that's what happened. So we got a lot of calls about USO. I think the product, there's a difference between whether the price of a commodity goes up or down or whether product stays popular. I think the product is probably going to stick around. But what happens with the price of oil? I mean, it's starting to balance out a little bit, but I still think there's a lot of drilling. And until you see some serious cutbacks, oil is going to be under pressure for a while.
Yeah, for those of you out there, a lot of you still asking about USO. Worth noting, and we have talked about this, check out our TWIFO episode from a few weeks back where we did a deep dive into all the issues with all things USO. Worth noting now, if you're getting into it now and it has reverse split, it's trading, I think, around $20-21 right now as of the showtime. So it has had a nice lift today, about 4 or 5%. But USO, very different beast than it was a few weeks or a month ago. Back then, it was pretty much just tracking front month WTI. We all know what happened to front month WTI. So then it rolled 80% front month, 20% second month. And now, as of coming into today's show, the target allotment, let me just break it down for you because it's a much different beast now. 15% in the July contract, 15% in August, 15% in September, 15% in October, 5% in November, 25%, so a full quarter of the weighting in December crude, and then another 10% in June of 2021. So if you're buying USO right now, you're not buying something that tracks that front month future anymore. You're buying effectively the broad breadth of the WTI futures curve out there. Now, that might be good right now to help it survive these shocks that are going on in the front portion of the curve. If you want something that's going to track oil 1-to-1, that's not a good thing. So bear that in mind when you're trading this product. It's a very different beast than it was even a few weeks ago. All right, unfortunately, that music means we've come to the end of this episode of Options Bootcamp. I want to thank all of you for joining me and, of course, for joining all of us here on the old program today. Before we go, really quickly, let's go back around the horn. Let's start with the black-hatted one. Mr. Dan, if folks have questions about box spreads or USO, they want to call you up and say, hey, how do I hedge these crazy valuation levels over at MTM? Where should they go? What should they do, sir?
You can just hit me up on my website, markettaker.com, click the Contact Us tab, and we've been having more people contact us for one-on-one options coaching over the past 2 months than we have in the past 12 years. It's crazy. So apparently people know where to find me, just at our website, markettaker.com.
Yeah, it's a good time to be in the options information and education business. People are hitting us up like crazy over here as well. It's not the environment anyone wanted to drive business, but c'est la vie. We're here for you. And Dan is over there as well. Luke, same question for you. If folks are intrigued, they want to learn more about Equity Armor, maybe they want to hedge some USO or some broad equity volatility, where should they go? What should they do, sir?
They should just go to our website, equityarmorinvestments.com, drop in an email, a little message. We'll get back to you right away.
There you go. Equity Armor is the place to go. And on behalf of Luke and Dan and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for listening live. If you're listening live, you get a special bonus. You get to hear the next week's episode right now, because we're going to be recording it right now. A little bit of behind-the-scenes magic. Otherwise, we'll see you back there next week for more Options Bootcamp.
Options Bootcamp is brought to you by NASDAQ. From its inception, NASDAQ has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. NASDAQ. Tech forward. Leading the U.S. options market and continually rewriting tomorrow. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.